Have you ever wondered how to start investing in the stock market as a beginner? Welcome to our journey into the exciting world of stock investing, an adventure that promises both thrill and knowledge. Today, we're going to demystify the stock market, making it accessible and understandable for beginners. Investing in the stock market can seem like a daunting task, especially when you're just starting out. The constant flux of numbers, the confusing jargon, and the fear of losing your hard-earned money can be overwhelming. But fear not. Understanding the stock market isn't as complicated as it might seem. We believe that with the right knowledge and guidance, anyone can become a successful investor. And that's exactly why we're here. To guide you, to help you understand the basics, to equip you with the tools you'll need to navigate the sometimes turbulent waters of stock investing. So fasten your seatbelts, folks. It's going to be an enlightening ride. So let's dive into the world of stock investing and unravel its mysteries together. First things first, what is the stock market? Think of the stock market as a marketplace, a grand bazaar of sorts, but instead of buying and selling goods, shares of public companies are exchanged. But what exactly are shares? Well, when you own a share, you own a piece of the company. You become a shareholder, a part owner of the company. Now, these shares are also referred to as securities. Don't let the jargon intimidate you. Securities are simply financial instruments that hold some value. Shares are one form of securities, bonds are another. The place where all this buying and selling of shares happens is called an exchange. Some of the famous ones are the New York Stock Exchange and the National Stock Exchange in India. So, in a nutshell, the stock market is where buyers and sellers come together to trade shares, making it a vital cog in the wheel of our economy. Now that we know what a stock market is, let's move on to understanding how it works. Understanding the working of the stock market is crucial before you invest. So, let's dive into the mechanics of it. At its core, the stock market operates like a grand-scale auction house. It's a place where buyers and sellers meet to exchange goods, only in this case, the goods are shares of companies. Now, imagine you're at this grand auction. The buyers or the investors bid on the stocks, stating the highest price they are willing to pay. The sellers, on the other hand, ask for their desired price. The point where both these prices meet is the transaction price or the market price. This is how prices of shares are determined in the stock market. It's all about the tug of war between what someone's willing to pay for a share and what someone's asking for it. But let's add another layer to this. The stock market is not just about individual buyers and sellers. It's a bustling marketplace filled with thousands of buyers and sellers. This is where the concept of supply and demand comes into play. If more people want to buy a stock, demand, then sell it, supply, then the price moves up. Conversely, if more people wanted to sell a stock than buy it, there would be greater supply than demand, and the price would fall. Now you might wonder, how does all this take place? Well, it's through stock exchanges. Think of places like the New York Stock Exchange or the Bombay Stock Exchange. These are the platforms that facilitate these transactions, ensuring everything runs smoothly. In essence, the stock market is a complex system where shares of publicly traded companies are issued, bought, and sold. It's a place where every day, every second, money changes hands and fortunes are made and lost. But remember, while the mechanics of the stock market may seem complex, understanding them is just the first step in your investment journey. With a basic understanding of how the stock market operates, we can now look at how to start investing. Investing in the stock market may seem intimidating, but it's simpler than you think. The first step to get started is opening a brokerage account. This is your gateway to the world of investing. Just like you need a bank account to save and spend money, you need a brokerage account to buy and sell shares. There are numerous brokerage firms out there, both online and offline, each with their own fees, features, and benefits. It's paramount to choose one that aligns best with your investment goals and comfort level. Now, you've got your brokerage account ready. The next step is to research potential investments. This is where you need to put on your detective hat. Look for companies that are performing well, have a solid business model, and are poised for future growth. You can use various tools and resources for this, like financial news, company reports, and stock market analysis. Once you've done your homework, you're ready to buy shares. This is where things get exciting. Buying shares is essentially buying a piece of a company. You're putting your money on the line, betting that the company will do well and that its stock price will increase over time. Remember, the key to successful investing is diversification. Don't put all your eggs in one basket. Spread your investments across different sectors and industries. After you've bought your shares, the last step is to monitor your investments. This doesn't mean you need to check your portfolio every second of every day, but you should keep an eye on how your investments are doing and make adjustments as needed. This might mean selling off underperforming stocks or buying more shares of a company that's doing particularly well. Investing is just the beginning. Now, let's talk about how to manage and grow your investments. Investing is not merely about buying shares, but also about managing and growing your investments. Now, let's delve into how you can do just that. There's a saying in the world of investing: don't put all your eggs in one basket. This essentially means diversifying your investments. When you spread your investments across a variety of stocks, you're not only limiting your risks, but also increasing the potential for higher returns. Think of it as a safety net. If one stock doesn't perform well, others might. But diversification isn't just about investing in different stocks. It's about investing in different types of assets. This could mean a mix of stocks, bonds, real estate, or even commodities. The goal is to have a well-rounded portfolio that can weather the ups and downs of the market. Now, once you've diversified your portfolio, it's crucial to keep a regular check on your investments. This doesn't mean you need to check your portfolio every hour or even every day, but a routine check-in, say once a quarter, can help you understand how your investments are performing. It's like a health checkup for your portfolio. If you see a stock consistently underperforming, it might be time to reconsider its place in your portfolio. Lastly, let's talk about the importance of a long-term investment strategy. The stock market can be volatile, with prices fluctuating every second. But remember, investing is not a sprint, it's a marathon. It's about the long game. History has shown that over the long term, the stock market tends to rise. So, even when there are temporary dips in the market, don't panic. Stick to your strategy, hold on to your investments, and in the long run, you're likely to see growth. With these strategies, you can successfully manage and grow your investments. But there's one more thing you should know. Investing in the stock market comes with its own set of risks and rewards. This statement holds true for all investors, whether they're just dipping their toes or have been swimming in the market for years. Let's start with risk. What does it mean? In simple terms, risk is the possibility of losing some or all of your investment. Stocks can be volatile, which means their prices can rise and fall rapidly in short periods. This volatility can lead to potential losses. However, it's important to remember that risk is an inherent part of investing. Without risk, there would be no potential for rewards. Now let's talk about those rewards. When you invest in the stock market, you're essentially buying a piece of a company. If that company does well, the value of your investment increases. This can result in two types of rewards: capital gains and dividends. Capital gains occur when you sell your stocks for more than you paid for them. Dividends, on the other hand, are a portion of a company's earnings that are paid out to shareholders. But here's the thing. The potential for high rewards comes with high risks. This is where the concept of risk tolerance comes into play. Risk tolerance is your ability to endure losses in pursuit of potential gains. It varies from person to person and depends on factors like financial goals, investment horizon, and personal comfort with uncertainty. So, how do you manage risks and rewards? It all comes down to informed decision-making and patience. Researching and understanding the companies you invest in can help mitigate risks. Diversifying your portfolio or spreading your investments across different types of assets can also help balance risks and rewards. And remember, investing is a long-term game. Patience can often be the key to reaping the rewards. Remember, smart investing is about balancing risks and rewards. And with that, we've covered the basics of investing in the stock market as a beginner. So, are you ready to take the plunge? The journey may be filled with ups and downs, but the potential rewards can make it all worthwhile.